Just when you thought the waters were calm, SoFi takes a dive. We're talking a double-digit slide, nearly 10% wiped off the board in a single trading session. Is this a panic sell-off or just the market digesting a massive meal? Today we're breaking down exactly why SoFi is bleeding red, what on earth a Greenshoe option is, and why $1 billion cash injection might be the bitter pill investors have to swallow before the cure kicks in. Welcome back to the Daily Stock Drop, your go-to spot for the market moves that matter. I'm your host, and we've got a lot to unpack on SoFi Technologies today. But before we dive into the charts and the chaos, I am not a financial advisor. I'm just a guy with a microphone and a passion for the markets. Everything you hear on this channel is for entertainment and educational purposes only. The stock market is a casino where the house usually wins, so always do your own research. So, let's set the scene. It's January 6th, 2026. You check your portfolio and SoFi is down. Ugly down. It's trading near $26.36, taking a 10% haircut intraday. Why? Because the underwriters of their December deal just came back for seconds. Here is the technical breakdown. Back in December 2025, SoFi launched a massive common stock offering. Part of that deal included a 30-day option for the underwriters, known in the biz as the Greenshoe. It basically lets the banks sell more stock if there's demand. Well, they just exercised that option partially. Specifically, they sold an additional 3.2 million shares. That brings the total shares sold in this entire saga to over 57.7 million shares. And the price tag? They sold them to the public at $27.50 a pop. Do the napkin math, and that means SoFi has raised roughly $1.59 billion in gross proceeds. That is a massive war chest. But here is the catch, and the reason for the drop: dilution. When you flood the market with nearly 58 million shares, the existing shares become a little less special. It's simple supply and demand. The market is digesting this incremental supply, creating what we call an overhang. Traders see more shares available and get nervous, leading to that sharp sell-off we saw today. But here is the nuance that the panic sellers might be missing. The underwriters only exercised part of the Greenshoe, about 39% of what they could have taken. This signals two things. One, there was decent demand, enough to justify selling more shares. But two, it wasn't a frenzy. They didn't max it out. So, where does that leave us? Short term, yeah, it hurts. The stock is choppy and liquidity spikes are creating volatility. But for the long-term bulls, you have to ask, what is SoFi going to do with $1.6 billion? If management can deploy that cash into high-yield growth, tech expansion, or strengthening the balance sheet, this dilution might just be a speed bump on the way to higher highs. The market hates uncertainty, and right now it's choking on the extra supply. But cash is king, and SoFi just crowned itself. The question is, can they govern effectively with it in 2026? That's the drop for today. If you found value in this breakdown, smash that like button. It helps the algorithm more than you know. And if you want to stay ahead of the daily drops, hit subscribe. I'll catch you in the next one.